Good day to everyone. This is InnMind channel with the best information for startup founders and tech entrepreneurs. And today we continue the topic about blockchain, DeFi, and crypto venture capital sphere. And today we have really cool guests. You know, guys, usually we make interviews with managing partners of VC funds, but I truly believe that one of the most important people in the venture capital firm are venture analysts. Those who are really researching the startups, analyzing them, and supporting the decision making by the results of their analysis. And today we invited venture analysts from Fabric VC, which is considered one of the well-known and very recognized VC firms investing in blockchain and DeFi startups, Ian Emerson. Hello, Ivan.
Hi, thanks so much. Pleasure to be here.
Yeah, and thanks a lot for accepting my invite. And when I invited you, we actually discussed, you shared your experience with me on how do you analyze startups for investment. And I thought that it's a shame if we can't share it with other audience as well. So I would love to go deeper with you into that questions. But first, could you please briefly tell us about Fabric VC? Maybe we will find some people who don't know yet.
Yeah, so we were founded in 2017 out of an angel syndicate the managing partner founded and some of his colleagues from OpenOcean, which is a traditional B2B SaaS VC in Helsinki. The issue that they found was they were really restricted in the sort of investments they could make. So they were happy doing Web2 investments, but they were limited with all these new opportunities in Web3. So what do I mean by Web3 is what we see is waves of the web over time. So the first iteration, the most simple sort of implementation of the internet beyond email that gave us Amazon, eBay, PayPal, Google, those sorts of companies in the dot-com bubble. And then the introduction of Web2 brought mobile, social, always being connected and cloud. And so that was Facebook, Shopify, Uber, Airbnb, those sorts of companies. But the issue there is actually that the user and the platform aren't aligned in incentives. So the platform takes users' data, abuses it, actually charges users rent in either their data or a subscription to use the platform, and the user gets nothing back. Take an example like Facebook, you create content for the feed, you give up your personal data that is sold to advertisers, and you don't benefit from it. So what Web3 does is actually allows platforms and users to align incentives via the use of tokens and giving back ownership of user data to the user, as well as having them own the platform and then also their identity. And so it's that shift that started with Bitcoin, but was accelerated by the introduction of more complex smart contracts with Ethereum that is now grown into DeFi today.
Awesome. So it means that every tokenized startup can be considered a Web3 startup.
Exactly, but it's broader than just tokens and like permissionless blockchains. It's really about the democratization of data and giving power back to individuals.
Okay, and Fabric VC is active since 2017. If I understand correctly, that's quite a long time for blockchain VC, because a lot of those ones who were super active and well known in 17, 18, they simply do not exist today. Do you know how Fabric VC managed to remain even during the crypto winter and those down times as well?
Yeah, with some difficulty, as I understand. It was before I joined. I was quite fortunate to join effectively at the end of the bear market and enjoy the bull run we're in right now. But there were some tight financial periods during that time. But actually, the investments made during the bear market are the ones that are most profitable once you come to the spring and then the summer. And so that's where really the strong VCs will prevail, and the opportunistic ones who only come out when all the hype appears in the media in the bull runs, they aren't long-term sustainable.
Oh, that's amazing concept. Actually, in traditional VC world, we have the same. So by statistics, the most successful cases in the VC world we had during the crisis times when it was financial crisis or the depression or something like that. So in DeFi and blockchain world, it's very similar, correct?
Yeah, exactly. Because that's when innovation happens. So anytime there's a crisis, that's an opportunity for winners to emerge. So in fact, the global financial crisis, which spurred the creation of Bitcoin, the same thing happens with the ICO boom in 2017, where there's lots of scam projects and shitcoins where people are trying to pump and dump and make a quick buck. But actually the genuine projects that continue building during the bear market then have really awesome products and protocols to deploy now, 2020, 2021.
Okay, and when you you joined at the beginning of the bull market, so you were not participating in the analysis when it was a bear market, correct?
Right, just at the start of this bull run. I mean, I formally joined the firm, I think, when Bitcoin was around 10,000 US, something like that.
It is 50,000 before.
Yeah.
Okay, and do you see the huge difference in the market, right? I mean, the market is definitely different, but in your everyday operations, what has changed since then?
There's a lot of deals. There's just everyone is trying to raise money right now, or in the last few months, just because it's such a great time. When the market is doing well, then invest. That there's more capital flowing into the system. You also get, as I mentioned, these sorts of opportunistic players who come in. Every 4 years, it's the same sort of names that you saw from 2017, 2018, who suddenly, oh, there's all this money, I can almost trick newcomers coming in and make a quick buck. And then there's other people just trying to make a new project, ship a new token. But for the most part, it's just a lot of deals, a lot to try to keep on top of. It's already difficult enough with the number of verticals that you're meant to try to understand, at least at a surface level, that it's pretty difficult to keep on top of.
Did you adjust somehow your investment strategy or shifted your focus since all this hype started again?
Well, it's just sort of different verticals and innovations that come to the forefront. So obviously everyone's talking about NFTs right now. When I first joined, actually, that was the first thing I deep dived into, was the whole NFT market effectively. And I mapped out all the different use cases. And so I'm a bit tired, to be honest, of hearing people, oh, have you heard about NFTs? Is this cool new thing? Without really understanding what it even is, or most people just think it's synonymous with crypto art, which is, barely scratching the surface of what, maybe it's worth just explaining now what a non-fungible token is. So fungibility is the property of something to be exchanged with another one of itself, and that's inconsequential. So take $2, you can swap either of them, you don't care which one you own. A commodity, you don't care if it's a kilo of gold from here or there, or stocks, you don't care which share you have. By comparison, a non-fungible asset is something like a piece of art, right? There's only one of them, or there's a series of prints, but they have serial numbers, and so you can identify your specific one, or even documents, a deed to some land. So all these things are non-fungible. And what we previously had in the crypto space is lots of fungible tokens. So Ethereum ERC20s, which a lot of projects use, Bitcoin is fungible, but we didn't have, or we did have, but just not to such a mature degree, non-fungible tokens. And what they really enable is not just collectibles, a piece of art that you can stick on a TV in your house, a sports card. Whilst these are nice, fun applications and actually a good on-ramp for new users to the industry, what it really allows is truly digital economies. So you could imagine one day where actually you can operate in a digital environment, in a digital living room, at a digital desk, working with non-fungible tokens as the deed to your house, invoices, documents, actually more boring things, financial instruments, but actually more core to our lives. And so that's where I think NFTs are really interesting.
So does it mean, my shame, but I myself first time heard about NFT around a month ago, and I was sure that it's only about art and gaming, when you can exchange different, I don't know, arms or whatever in the game. But now you say that even contracts, documents, and invoices can become one day NFTs.
Yeah, so fundamentally, it's a token, so you can ascribe ownership of this token that represents some non-fungible asset in the real world. And so that can be applied anywhere. And the art market, it's nice. It's sort of tens of billions is the market cap or sort of value each year. Gaming, again, maybe 100 billion, a few hundred billion, but all non-fungible assets in the real world, that's trillions. It's many orders of magnitude larger than gaming or collectibles.
Okay, but when we speak about NFT potential, so when you identify different startups, I know that a lot of people are trying now to benefit from that. Like, for example, bloggers, influencers, they try to make their own NFT token, or artists. I sometimes also paint, so maybe one day I will get crazy enough to make NFT from my paintings. But as an investor, how do you decide where do you invest in NFT or not?
Well, we have a few investments in various different NFT verticals. One of the more successful ones would be SoRare, which is right now it's a fantasy football league with digitally scarce trading cards. So you can own these cards which represent players, you participate in weekly tournaments, you earn rewards. That's a nice application. It's sort of easy to understand, but it's not obviously huge. I mean, they just raised a 50 million round, so it's pretty big, but it's not going to change the world. But actually, if you extend that, what's really happening is it's a new way for clubs and players to directly engage with their fan base and to create this connection so that when you're watching a game, actually you have these cards associated with it and the outcome of the game is going to directly influence, the leaderboard and all this. So it's a whole new experience for enjoyers of football, or it can be extended to other sports to, consume that content. And then that's just one sort of nice collectible use case to do with sort of distribution marketing. But another investment we have is Centrifuge. And what they do is invoice factoring. So you can take, lots of different instruments, but one example of a company they work with is Paperchain. They will take the API you get as a creator from YouTube or Spotify for the number of streams you have, the number of ads that will run. You can take that, tokenize it as an NFT, use it as collateral to get a loan and get paid instantly, compared to 60 days that creators currently have to wait to get paid from these platforms. And so that's actually something or a use case where creators can directly benefit from this technology. They can get paid 2 months in advance than they otherwise would have.
So actually, yeah, I understand your point. The core is making this direct influence or more fair distribution of rights or copyrights for arts or whatever to the creators themselves. But I don't understand all this hype about NFT, because even a few years ago, before all these new bullish market, we had a lot of startups who are doing, for example, stock images on blockchain for fair distribution of copyrights, or, for example, these cards for football players and celebrities, where they can issue digital cards, sell them to the fans directly. And all this was not called NFT. It used blockchain technology, but nothing with these three letters, NFT. It was, I remember, very hard to fundraise for those startups a year ago or half a year ago. So what is the difference with NFT in this case?
Well, I mean, NFT is just a word that's been ascribed to these tokens. I think, honestly, it will probably die out with some time and you will no longer talk about an NFT, but rather a piece of digital art or a collectible or your invoice or whatever it might be. There's a couple reasons, I suppose, why it's been accelerated now. So firstly, the technology's matured and we have a much broader ecosystem that it can be used in. You have marketplaces where you can trade them. So I mean, OpenSea is the most well-known sort of agnostic NFT marketplace, and they were from a 2018 Y Combinator. So it's been in the making, as I said before, during the bull run is when it gets built, and during the bear market is when it gets built, and during the bull run is when they actually benefit. And then the second thing would be COVID has played a huge impact. And that's where it's really accelerated the art side of things, is that there's lots of artists who can no longer really directly connect with their collectors. And NFTs have enabled them to access this new market to still sell their artwork. Without galleries being open, without being able to physically interact with people.
Okay, so it means that you can not only enjoy the art pieces from your computer, but also buy part of them. So It is the tokenization of art, yes? When you can buy a lot of pieces of different arts without spending a fortune to buy one painting.
Well, I mean, you still maybe spending a fortune to buy individual NFTs. Obviously, Mike Winkelmann just sold his first 5,000 days of he's been producing a new piece of digital art every day. Sold that for $60.3 million plus another 9 million in fees and effectively 69 million to pay for a single JPEG. So it can still get expensive. It's not just buying a JPEG as if you were taking a picture of the Mona Lisa or Googling it and looking at it. It's you actually have ownership of that piece of art, and that's what the NFT represents.
Okay. So I hope that right now I will be able to identify NFT startups and see the potential from a different angle. But coming back to the Fabric Ventures, what is your medium term, not termship, but the length of the investment you are making? You are doing this long-term investment strategy, yes? What is the general timing?
Yeah, exactly. So, I mean, for Fund 2, it's a typical VC structure. It's a 10-year time horizon in terms of distributing to LPs, and it's a 4-year investment period. What's strange about this space is that it's VC-like returns or mindset, but actually you have hedge fund-like liquidity. So in a typical VC, you'll invest equity in a company and you'll expect it could get acquired, or you could sell some secondary shares, or it will IPO in some number of years. Whereas actually a lot of the time, the investment event for a crypto startup coincides with a liquidity event. So you buy a token and it's immediately liquid, or 1 or 2 fundraising rounds later, they do a public round. So as an investor, it's quite distracting because suddenly you have to be managing all of these liquid investments where you actually have the opportunity to sell within a month, within a year, whereas you still have this long-term mentality of trying to nurture the team, support them, make connections, and have this 10-year outlook.
Okay, so did you ever exit 1 month later after investing?
I personally have with my personal accounts. So the graph was a very good buy at that. When was it? Sort of November last year. And then a month later, it had already done 20x. And you're not going to say no to that. As Fabric, we still tend to have a very long-term outlook. Unfortunately, during a bull run, prices are incredibly inflated. And so you're no longer doing a service to your investors, to your limited partners, if you aren't locking in those returns that you can see. Right? Once an investment has done 100x, you have to think, right, the fund has returned its money, we should probably take some money off the table. Not to say we're going to sell everything and then completely cut ties with the company, but we will lock in some of those returns.
Okay, but if I understand correctly, correct me if I'm wrong, majority of good startups and good investors also require some locking period. So you can't sell, even if you want, you can't sell the tokens 1 month after you signed the deal, correct?
Exactly. And that's really not a problem for us because any investment we make, we do have that long-term outlook. And so we're quite happy to be locked up for a long period because we're working with the team to ensure that real value is created and it's not just speculative hype that means that the token gets inflated in value. And so it's fine for us to be locked up for, say, a year and then it vests over the next several years. We're quite happy for that, especially if in a lot of cases, you can buy on the public market in a private deal so that you can have a discount, but it's locked up. We're quite happy to do that.
Okay, so that is maybe what is different between Fabric VCs and many other investors in the area, because you do this long-term strategy. But do you also sometimes enter the speculative deals?
Not as Fabric. We don't currently have a liquid fund. That's something we're looking to do in the future. Right now, we're just really focused on closing out Fund 2 so that we can start investing out of a bigger pot. That's going to be a 100 million cap fund. First close will be in 2 weeks' time. So we're really focused on that. All hands on deck for Fund 2. In the future, we want to have a liquid fund, which will be trading on the markets again, not sort of just trying to high frequency trade and do arbitrage and try and, make really short-term investments, but still looking at projects that we believe in, that we know have a strong team, that we know have a really good go-to-market and are operating in a really promising space, and hold those for some period of time until we think they're overvalued or we think we should get out.
Okay, and what value do you bring in addition to money? You already said that you are working with teams very closely, so probably you are advising them on the strategy. But what else do you bring? Maybe I heard a lot of VCs, they offer also marketing support, influencers, PR or whatever, or exchanges as well. What is in your case?
Yeah, exactly. So as with any VC, traditional or in this space, you have the usual things like hiring, like helping with future fundraising, connections to partnerships, customers, marketing, as you say. But especially in this space, it's really difficult because, as I said, it's almost like having to IPO at the same time as building your tech, at the same time as going to market, at the same time as building a community, and it's all happening at the same time. So for Web3 companies, it's really difficult. And so we help them with that market infrastructure, introductions to market makers, exchanges, liquidity provision. We help with exec coaching because a lot of these are young people who haven't built a business before, who haven't sat on a board. So really shaping those foundation councils in the case of, for example, Richard, the managing partner, sits on the foundation council. I help him a lot with the work there. And then lastly, token design. And so really helping their thinking in terms of what will the utility of the token be? What should the total supply be? How should it be distributed? What should we be incentivizing for liquidity or otherwise? So there's a lot of different nuances that traditional VCs don't have to deal with, and that we bring help there.
So does it mean that you're investing in really very early stage when the startup does not even have yet the token design?
Exactly. So it could be, we'll invest as early as possible, pre-seed, seed. It could be that they are planning to have a token in the future, but for now want to keep it centralized so that they can be nimble. And so then they'll need help in terms of how to build out the community. And so we can help there with the token design. Or it could be they already issued a token, but there's some issues with it. And so they need help redesigning it in terms of the total supply or what utility it has, etc.
So you don't need to be an expert in token economics to go apply and maybe even fundraise from Fabric VC. If one day we at InnMind decided to tokenize our platform, we should probably approach you and ask how to do it, correct?
Right, sure, go for it. Always happy to chat.
Okay, and when we speak about your core everyday activity, analyzing the startups, Ian, where do you start?
Let me check my calendar. A lot of my time is spent chatting to founders, setting up meetings with founders, researching into a space, just trying to understand a vertical as deep as possible, who all the different players are. When actually evaluating, it's honestly very similar to a traditional VC. You'll think about the market, how big it is, how big the company could be, what traction they've had so far, what the go-to-market is going to be, what their product looks like, what competitors they have, but probably most importantly, at an early stage, who are the team? Do we believe they can execute? Because unlike in traditional VC, or depending on the market that you're talking about, you may have a lot more defensibility. Whereas in this space, because a lot of the time, particularly in DeFi, everything is open source. Your smart contracts can be forked at any time and anyone else can use them. It's not about, have I built a really good smart contract, but can I execute on that? Can I keep innovating and ensuring that I stay ahead of other people who might just copycat? And so you see hard forks all the time, like Uniswap to SushiSwap, like Compound to Cream, and actually the fork very oftentimes is able to innovate. So initially SushiSwap kind of flopped, but then they've come back and done very well by continuing that development and innovation. And so you have to believe that the team you're backing is able to keep innovating faster than anyone else.
And how do you identify it? Because on the early stage, you can't see probably a lot of traction. You most probably will not see the community, which is the core in each DeFi and tokenized startup. They simply do not have money and marketing resources to build a huge community. So how do you identify this on early stage, capability to execute?
what is, you don't necessarily need lots of money to market. You can go about it in a clever way. So if they've been in this space for a long time and they're not someone opportunistic coming in and trying to raise, then they should have a lot of connections. They should be well known. We can get references from our advisors or others to recommend that, okay, yeah, this person's really smart. I've spoken to them before at this conference and they're really on it. They have good ideas. They're well connected. And so then we can have a strong conviction that they'll be able to execute on their plan and carry out some things that, yeah, are quite subjective, like I will build a community in Discord or Telegram by leveraging my Twitter network or whatever. But actually, okay, they can do that because they know these people and they are well respected in their whatever vertical they are.
Okay, so first, traction, as the same as in traditional VC world. Even if you do not have money yet, you just start. Traction and customer development. In this DeFi world, it means building community. Yeah, it's like customer development.
Yeah, community is super essential for the same reason I said before. The defensibility of your product is very low. Anyone can fork it, build a front end, and they have the same thing. Whereas the community is really what protects you from that, especially the community being evangelists and doing the marketing for you because they're incentivized through ownership of the network through a token, or the community providing liquidity to your protocol. So something you can fork very easily is the smart contract, but you can't fork the state and copy the liquidity over to your new project, whatever fork. And so the community provides that moat versus anyone who just wants to copy you.
Oh, I love what you say, because really, as I told you already, it is like golden middle. I'm in traditional VC world. When I talk with super crypto VC funds, their approach is so different, but Fabric Ventures and your approach is really reminding me a lot to those one in traditional VC sector, where you focus on community, customer development, as we call it, when you do a lot of research, market investigations, and first traction, even without money, without backup. What I see right now a lot in DeFi sector is that startups are doing different. They, of course, I understand them, they benefit from this situation. So first they try to close the round, seed, pre-seed or whatever. And very often it's also shocking. We see they are oversubscribed, meaning they receive more offers from investors than they can digest. And then they decided to hire marketing agencies, PR agencies, influencers. How do you think this approach is, on your opinion and Fabric Ventures' opinion, is destructive, or it is just okay as well?
Yeah, you see that a lot right now. Is a lot of rounds opening and closing very quickly, oversubscribed, and then doing a second round very shortly after at a much inflated valuation. I wouldn't say it's necessarily destructive. People will lose out to some of these projects where they are raising money against a token that doesn't yet have any utility, and that there's nothing they're investing in at a 30 million valuation, say. But ultimately, the projects that are genuine and that are building something in the background and will have a token that accrues true value will survive and benefit the ecosystem.
Okay, and what else do you consider while investing? So do you do this legal analysis, or you ignore this because a lot of startups, they even don't have legal entity?
Right, so it depends, because we also invest in equity in companies. When you're talking about decentralized projects where you're just investing in a token initially, then no, it's fully, it's decentralized. The team is across multiple different continents. The company is a autonomous protocol that is running on a decentralized network. So we don't worry about regulatory risk in that context.
But DAO, the decentralized autonomous organization, does it mean that it is out of the regulation at all? So everyone can make DAO and not care about about regulators?
At this point in time, I think so. Given that they don't operate in any given country or legal jurisdiction, like no one can shut them down, right? If one country like India has just announced bans cryptocurrencies, whatever that means, the DAO will continue to exist globally.
Okay, so but you consider that at some point of time, maybe in a year, maybe later, governments can step in again and do something with them, and as usually start with some big cases showing how they can punish some specifically successful cases.
Yeah, so they could punish individuals, like we've seen with Arthur Hayes, or potentially in the context of Ripple or Tether, but you can't punish a DAO. In general, I think it's better to take the approach of asking for forgiveness, not permission. So nascent in this industry that, if the regulation, which always has to catch up, isn't written yet, then you're better off innovating and then being told you can't do that rather than saying, oh, but what if we're not allowed to do that in the future.
Okay, so that is why everyone likes DAO these days, because even if some individuals will be, let's say, in the worst case, present, it will not ruin the whole business, the token economy, and everything, correct?
So individuals may lose faith in the project because some of the leaders within it have been punished in whatever way, but it doesn't mean that the DAO has to stop functioning.
Okay, I see it. And speaking about evaluating of investment opportunities, one more time, you said the team is very important. And let's imagine I'm traditional investor, have no clue how to identify all these DeFi and NFT startups. I see the team, they are really cool guys, super motivated, and they have small community. But how can I know that they are doing something that would succeed in half a year or 1 year?
Wow. Well, if I knew, we'd do very well, wouldn't we? I think it really depends on the exact project you're looking at. If they've built a new primitive that no one has done before, and you can see how that slots into DeFi and other projects will build off that, then there's clearly some potential there. And if you think they can execute on that, then all the better. Yeah, if you see that they have experience building other projects, they've done other things that you know of, they've worked at projects that are well known and successful, then they've at least been exposed to a culture that was conducive to building good projects. It's stuff like that. If they've been referred to you by someone that you highly regard who says this team is stellar, they're executing really well, they're doing great stuff, their community is thriving, then yeah, that's a good signal as well.
Oh my God, one more time, very similar to traditional VC. So guys who will be watching this video, if you do not have reputation and successful projects in your background, then ask some very respected people in your network to introduce you to VCs, and then it will be a little plus to your karma when venture analysts will analyze your startup, correct?
Yeah, well, I mean, it's only natural. Everyone's busy. You want to limit how much cognitive load you have. So if you can have a good signal by being, someone you respect has sent it along to you, then that just removes some question marks that you have to go, is this just a complete scam? Do I have to read through it and understand, looking at their website, all this marketing lingo, which is bullshit, or actually they are doing stuff in the background? It just reduces some of that strain.
Okay. And then if we talk about red flags, so what red flags do you mark in your mind when you analyze the startups?
So as I just sort of mentioned, if on the website they say stuff like we use the most advanced technology in scaling this or that, without actually specifically saying, oh, we're running on optimistic rollups, or just say what technology you use. If you have nothing to hide, then you should be able to just disclose everything openly. If they're doing lots of marketing, but there's not obvious evidence of a lot of building or a lot of activity happening, that their community isn't very strong, they have no followers on Twitter, their Discord channel is empty, no one's saying anything, that's a big red flag. If they've just showed up in the last month when Bitcoin broke 50K, but you haven't heard of them during the 3 years that it was under 20K, then that's probably someone just trying to be opportunistic. If they're focusing really a lot on token and we're doing this private round, and then we're doing a second strategic one at this price, and then we're doing a third public round at this price, then they're too focused on just how do we make money by selling a token, not how do we build a genuine project and a token happens to accrue value to capture that. There's probably other ones that I miss off the top of my head, but you slowly pick up on these different things where you can eventually sniff out a project and immediately go, yeah, that's bullshit.
That is really cool. But the last point which you mentioned about focusing too much on tokens, I feel a little bit confused because again, maybe it will be a silly question, but a lot of founders told me that they do not have a business model, traditional business model in this space because they do not sell anything. They will earn later on the token performance in the exchanges. And that is why the core value, the core business value is focused in their token economy. So what do you mean by focusing on tokens? Is
right. So I mean, the business model, exactly as you say, will be captured in how the token works, what utility provides, what demand it induces, what supply you give out. What I mean by too much focus on the tokenomics in terms of we're going to sell it at 3 cents this round, and then we're going to sell it at 4.5 cents next round, and then we're going to sell it at 12 cents the round after when we do an exchange offering. And so at no point have you mentioned, this is the utility the token provides. All you've said is this is how I'm going to keep making money by selling this magic internet money. And so that's where, okay, you're too focused on your token in terms of what you're going to sell it for, rather than what you're going to use it for and how it's going to accrue value. A lot of founders fall into the trap of thinking we have to raise money by doing an ICO or initial exchange offering or initial decentralized exchange offering. Actually, they haven't figured out what the token does. And once you launch a token, you can't unlaunch it. And once it's launched, you have to worry about all of these thousands of stakeholders who, are going to be fluctuating the value of your company every day. You have to worry about distributing it, about potential hackers or people trying to scam or exploit you. And it just creates so many overheads when, as I said before, you're also trying to go to market, build community, build your product. And it's unnecessary extra load that you don't need. Is just to raise money. There's other ways you can raise money with a simple agreement for future tokens rather than actually launching the token.
Okay, I see. So actually what you mean about token economy is in it translating to the traditional world, it will be something like your customer or user journey and what benefits they will get, what is your value proposition for your customers, and how you will keep them engaged in future, correct?
Exactly. It's like, why would someone actually want to hold this token? A lot of cases we have this token, we have a native token that we reward users with. Okay, great. But what are they going to do with that token? If it's just worth some amount of money, they're going to immediately sell it. And so now you're rewarding people with a token that is worthless. And so you have to reward them with more of it because the price goes down and more, and it sort of turns back into the money printing that all of this is, that Bitcoin's meant to sort of circumvent. And you're just trying to print more and more token to reward people with, which they're then just selling to extract the actual sort of fiat value out of.
Okay, and plus when the fee goes to the token holders, then it can be considered by regulators as a kind of dividends.
Yeah, exactly.
So there
but
is
again, that's it's not the best example because that just feels like it's equity. And so it's not actually improved on equity, it's just a digital representation of it.
Yeah, it's like you are holding a building and then you are selling the rent or getting...
Exactly.
Yeah. Okay, let's not break your head. I have a lot of argues with traditional VCs and my friends like Anton Nantic, who is from traditional VC world, their main argument is that show me at least one case in the blockchain and crypto startups world where the startup reached success and due to its operations bringing benefits to the investors. So not speculative benefits, but like dividends or whatever, when investors are happy during long term. Can you give such examples?
So does it have to be in a token? Because for example, SoRare, they're turning very strong revenues. You could use all your traditional measures and they're a strong startup. The same one that raised 50 million recently, and they are operating in this space. They issue NFTs, but they don't have their own native token.
Nice. I think that's a great example, and I will gladly put the description and the link to their website, so we'll support them a little bit in marketing. Sora. Okay, I've never heard, to my shame, about that startup, but I will learn about them more. And any other example?
So, well, it's difficult to separate speculation from what you think it's actually valued at, because it's all almost speculative on this entire ecosystem continuing to grow, and that more and more use cases will move onto platforms like Ethereum, Polkadot, Near, etc. And so you wouldn't value it at the prices they're valued at right now based on the number of transactions happening, but you might, based on the amount of liquidity available, perhaps is one way you can measure decentralized exchanges, the amount of trading that is happening. But the issue there is that it's still circular. It's like crypto money being reused and turned into other crypto money. And the real thing we haven't sort of figured out perfectly yet is how to link all of this to the real world. So that is something where NFTs could really work to, prove ownership of real world assets, bring them on chain, and then you can use them in some interesting way. They can be collateral against a loan, like I said before, or you can loan them to other people who can then use them, or it just provides an easier means to transact, to exchange it. You could have decentralized commerce. You have an NFT that represents a real world item. You can send it to someone, they can redeem it, they can receive the item, something like that. And we haven't tied all of these decentralized networks to real world applications in a super strong way.
Okay, that sounds very reasonable. Thanks for sharing, Ian. And I remember you are limited by time, so just a few more questions and then we will finish. One of the questions is, where do you generate the deal flow? I understand that given that you are old company in this field, you already have reputation, so a lot of startups just come to you themselves and you don't need to run for them. But I know that you are also actively searching for new opportunities. What are your most efficient channels?
Exactly. So we have, a fair bit of inbound, be it cold from LinkedIn, by email, by other social media, or it could be referrals from other VCs, from our Scout network, from advisors. And then we also have outbound. So in terms of attending events, in terms of doing a deep dive into a space, mapping out all the most interesting players and deciding we want to reach out to these people and talk to them. So there's lots of different channels, and actually juggling all of them is a sort of fairly full-on task, which is a lot of my time.
So if I understand, it is more than half of your time on this deal sourcing, actually.
Yeah, I mean, I'd say the bulk of my time is sourcing deals and doing first conversations with founders. And then on the side is assisting with fundraising through deck work and other materials, and then doing research and publishing, so effectively marketing, so doing newsletters, doing Medium posts, that sort of stuff.
Mm-hmm. When you hear startup founders telling that they are oversubscribed, but they want to approach you, does it make the opportunity more interesting for you? It is like an advertisement, or it is a kind of red flag for you?
I mean, of course, like it's the founder's job to try and create FOMO in VCs. You can use it as just one signal. If you ask them who else is interested in the round and they say these three people have committed, and you know all of them and you respect them, then you can have a chat with them and say, okay, why have you committed to this fundraise? And so that helps you build a full understanding, but you don't just rely on, oh, A16Z did it, let's go follow them, right? It's just one signal among many for you to build your own conviction.
Mm-hmm. So speaking about real FOMO for VCs like you, it does not have the same effect as for short-term speculative VCs, correct?
Right. Yeah. So sort of retail investors aping into a project because they've seen it go up 10x in the last week, and they're like, oh wow, so it'll go up another 10x in the next week. I might do that with my personal money, but as VC, that's not part of the investment strategy.
Okay.
As Fabric.
And then the last question for today. As we discussed previously with you, there are a lot of different types of VC firms in the sector, and they all are really very, very different, like top tier VCs. Well, it is very subjective still, top tier. How many of them? 5 or 10? Is Fabric top tier, or next after top tier or whatever. Yes. So, but still, there are different funds, and with some of them, the good startup does not want to have anything in common, and some of them, a lot of startups want to have on board. So, how can a startup without good and established network in the VC world, where you can ask one VC about another, how can a startup identify red flags in the investor who wants to jump in on the round?
So if they're trying to force certain restrictions or terms on you as a founder, then just make sure you understand what sort of investment is coming in. Not all money is equal. Maybe if it's an equity deal, they're trying to force some liquidation preferences, 2x, whatever. If it's a token and they're trying to force you to give them lower vesting so that they can, dump on you in 6 months' time, really just make sure that everything's aligned between the founder and the investor. And that's the same on our side. We want to make sure that the team is aligned with us so that they're not going to just dump on us. Say, if we buy equity in some holding company, but they own all this token and they sell the token, or vice versa, they have all the equity and we're buying a token that is worthless. You want to just make sure that investors and founders are fully aligned, that they both have significant incentive to hold long term, and that neither is going to try and run pull the other.
And what about additional advantages like this marketing support to exchanges or whatever? Is it also a very heavyweight segment to look at?
Yeah, for sure. You want to have an investor who's aligned not only financially through their incentives, but also in terms of the vision for the company, and that they're going to help you long term and nurture you, provide the partnerships that you need, the marketing support, the hiring support, all the things I mentioned previously. It's about finding a good fit and finding as good a partner as possible. Hopefully we try and be, the best partner we can, and not just provide some capital and leave it and let the founder, make money for us, but actually help them. At the end of the day, they are still leading the company, but by being active participants in the network and the community, we can accelerate that growth.
Okay, amazing. Ian, thank you so much. I would love to ask you more and more and continue this interview, but I know that you already dedicated more time than you promised. So okay. Thank you so much for sharing your enormous experience and deep understanding of your topic. Maybe you are not yet a Nobel laureate for the tokenomics, but you still understand it on a very deep level. And I think that these insights will be useful for a lot of startup founders.
Awesome. Thank you so much for having me. It was really good fun.
Thank you, Ian, and I wish Fabric Ventures to become really unicorn in the VC field, and we will do our best to bring you good investment opportunities.
Cheers. Looking forward to it.